Thank you very much. I have to say, very interesting talks yesterday and today. When I joined PAG in 2009, we were roughly around 3 billion US dollars. Now we're 55 billion US dollars. And when we started in 2002, we were $10 million. And a lot of that really encapsulates the growth in Asia. And actually, we think Asia is an extremely interesting place for real estate, private debt, and there are a lot of gaps in that market. Now, I'm going to sort of divide the session into three parts. Firstly, a quick overview of the markets and the general strategy. We really do senior secured lending in the good jurisdictions in Asia, so namely places like Australia, New Zealand, South Korea, Japan, and now a little bit of India with the improved bankruptcy rules. Secondly, the opportunity set in our key markets. And for senior secured, we're getting 16, 17% unlevered at loan-to-value ratios around 50s, sometimes low 60s, and sometimes lower than 50s. Everything bilaterally negotiated with full recourse. So personal guarantees and/or corporate guarantees on every single one of our loans. So the market's actually extremely long. There are a lot of gaps, and there are very good reasons for that as well. And lastly, thirdly, why Asia? And Asia, really the answer is somewhere in between lack of credit in the system and actually lack of competition in the market as well among the non-banks. So turning to, I think, is there a clicker here, David? Yeah, there you go, yeah. So turning to the first slide, I think this really encapsulates a lot of the reasons why we're seeing opportunity in the market. Asia is really a bank market. It's less sophisticated than the US markets. Really, the big banks dominate. And for a jurisdiction like South Korea and Australia, you're down to the last few banks. So pre-Lehman in Australia, for example, there are 20-something senior banks, 20-something mezz funds. The mezz funds folded, and the senior banks, we were buying their portfolios, and they were literally giving up their licenses in 2010, 11, and 12. So we bought all the sort of Lloyds Bank, RBS, ING, Commerzbank's real estate back books, which really put us into the market. We're buying them at sometimes 28 cents on the dollar, sometimes 30 cents on the dollar, well below replacement cost. But stupidly, these banks gave up their licenses. Now they want them back, and APRA, the Australian Prudential Regulatory Authority, said, no, you're not coming back. So the big four banks in Australia, ANZ, Westpac, CBA, NAB, are 70-something% of the credit markets. And actually, on the stock exchange, you count those four banks, they're about 18% of the stock market, with a few resources companies there.